Hey, everybody, it's Eric Green. Welcome to this week's Tax Rep podcast. What I wanted to talk about very briefly, it's going to be short, is how to reopen a closed assessment. I get this a lot, right? What happens is the client calls, right? And you probably got this yourselves. I owe the government $200,000 from an audit. They come in, okay, we can look at an offer in compromise, installment agreement. We start in already on the collection aspect. And they'll make a comment like, I don't even know why I owe this. Okay, time out. Let's talk about that. And what we're finding more and more, everyone will tell you, well, enforcement is down. Well, it is sort of, but not really. More and more enforcement is being done through automation. More than 70% of the audits today are all done through automation, right? Automated under reporter, automated substitute for returns. And so what happens is, of course, they get the letter, either it's asking, please send us back up for these expenses, or it'll be a combo letter. And a combo letter says, we're proposing the following changes to your return. If you agree, just sign and we'll bill you. If not, submit the documentation and your case will go to appeals. In either case, the client sends in their documentation. Nobody looks at it. I don't know if they're burning it, taking it home to heat their house, eating it. I don't know what's happening to it, but no human being is ever looking at it. And then a 90-day notice of deficiency comes out. And either the client sticks their head in the sand, or they give it to the accountant that says, I'll deal with this, and it never gets dealt with. Long and the short of it is, the assessment goes final. And so now the client is stuck with this bill. But they're not really stuck with it, all right? Now, there are lots of opportunities to reopen this, right? One is audit reconsideration, where basically you submit to the IRS a request saying, here are the issues that we dispute, and here's the proof why we don't owe this. For instance, if they disallowed the expenses, we would submit all of the documentation saying, here's a copy of the return that was filed, and behind this are exhibits numbered that match the line numbers on the return with our backup. And you submit all the documentation. So long as it is something that was not seen before, you haven't been to you haven't signed a closing agreement or been to tax court, the government should look at it. Now, the thing about audit reconsideration is you need to call collections and get a hold, because it's not going to happen automatically. Another option is a doubt as to liability offer. This is an offer in compromise, but not one that's based on an inability to pay. This is based on, we don't owe you this money. Now, the thing, I'm going to explain doubt as to liability offer, and then I'm going to compare it to audit reconsideration, and because they're kind of similar when you want to use one versus the other. So a doubt as to liability offer, there are a couple things you need to understand. You have to make an offer. You have to offer something. You can't offer nothing. So if the client says, I don't owe them anything, you have to make an offer of something. Offer $10, but you have to make an offer. The other thing is, it is an offer. So everything with offers stays the same. You have to be in compliance. You have to maintain compliance. If the offer is accepted, that wipes out the liability that remains on the book. So, and that's a big difference. With audit reconsideration, if they fix it, and let's say they took refunds from the client, or they levied the client and took money, you can potentially, if you filed it within 2 years, get that money back. With a doubt as to liability offer, you submit it, collection stops automatically. It's an offer. It forces them to look at it. I tend to like doubt as to liability offers myself, but you cannot recover money that was taken. Okay? That's the difference between the two, and why you would want to perhaps pick one versus the other. You know what I use doubt as to liability offers a lot for? I use them a lot when we have to reopen trust fund assessments. Client comes in, they've been deemed responsible. They had never had check signing authority, never even did the 4180 interview. What happened is the company closed. Usually what happens is the company closed, it vanishes, and a revenue officer's just stuck. And so what they do is they go looking around for who were the managers, supervisors, who were the owners, and they just simply deem everybody responsible. And the person never gets their appeal. I use that a lot. So do consider the 656L if you have to try to reopen a trust fund assessment. Couple other ways to challenge this. If the client never received the notice of deficiency, which does happen, not often, but it does happen, right? IRS mails it to the last known address. Client never got it because they had moved, all right? You're allowed to bring up the underlying liability at your collection due process hearing. So now it's in collection, you get the final notice, you file your 12153, you get your CDP, right? Collection due process, CDP hearing. So long as you do it at the first opportunity, meaning whether it's on the lien or the levy, first, whichever one you get first, you're going to raise it, and you raise the underlying liability. Appeals will look at it. But again, it has to be first opportunity. So there are a lot of people that the lien comes out, they don't challenge the lien. Then the levy comes out, now they raise the issue. It's too late. You already had that opportunity. So you can't raise the underlying liability now at the CDP hearing. However, you can still file a doubt as to liability offer through the CDP hearing, which is also challenging the underlying liability. So again, we're in the audit reconsideration doubt as to liability offer. There are two more options beyond that. If the client can pay, you can always pay it and seek a refund. If the client hadn't been to appeals before during the original audit, they'll go to appeals now. And then ultimately, of course, if they can't work it out with appeals or it's taking too long after 6 months, they can file a refund action, right? Because they paid it, they can bring the refund action and start a refund suit. Again, it has to be enough money to make it worthwhile, but you can always start a refund action. The last place you can challenge a liability, and for those of you who've been through any of the payroll tax training that we do and all that, this is going to ring a bell. There's a very famous case. It's the U.S. Supreme Court case on trust fund responsibility. It's called Slodov, S-L-O-D-O-V. If you Google it, Slodov, U.S. Supreme Court, you'll get the case. That case came up through the bankruptcy court, all right? Bankruptcy court is a place where you can challenge responsibility for a tax and challenge the tax itself, because in bankruptcy, a debtor is allowed to challenge any claim put forth by a creditor. Say, I don't really owe that. And the bankruptcy court will hear that. And the bankruptcy court does tend to be more pro-debtor than, say, the U.S. tax court or district court. Now, I will warn you, bankruptcy courts are not really tax courts. They don't like doing this if this is the only issue you have. However, more often than not, people who have this issue have other creditor issues. So if they're going to do a Chapter 7 because of creditors and vendors and other judgments or stuff, you can challenge any of the tax assessments in the bankruptcy court. Right? So those are really the four options. So if you ever get a client, that's why I told you this would be short, but if you ever get a client who owes money to the IRS, and there's something wrong with this assessment, it's not correct, it's not accurate, the client does have options. So long as they didn't go to tax court and sign off on a final decision or get a final decision, or sign a closing agreement, which is not like, this is not signing an audit. You sign off on an audit, that's the audit. You can still challenge it later. But a closing agreement is an agreement where both parties, because of issues, agreed this is the settlement and we're done, and both parties agree in writing, government and the taxpayer, they are not going to reopen this, period. Other than that, you can reopen a closed assessment. Audit reconsideration, doubt as to liability offer, payment and seeking a refund. If they're in bankruptcy court for some reason, you can challenge it in the bankruptcy court. And in the event they'd never received the 90-day notice of deficiency, if they do it at the first opportunity, they can raise that at the collection due process hearing. Okay? So just know that it's, in fact, when I did this, it was a 2-hour program and I called it, it ain't over till it's over. All right? Why it is we can wake up those formerly, those what you thought was dead assessments. All right? You can always challenge this. So with that, go ahead, keep building your representation practices. If you have any questions or things you want covered on a podcast, email us at podcast@taxrepllc.com. There'll be a link below in the description. And otherwise, I'll see you next week. Bye-bye.